The hardest action, not making a trade. The psychological anatomy of inactivity in investment. For most people in financial markets, the hardest thing isn't making a wrong trade. The hardest thing is not making any trade at all. While staring at the screen, watching prices move, watching the news flow. It's incredibly difficult to take your hand off the mouse, put down the phone, and do nothing. There are powerful psychological mechanisms behind this. 1. The human brain is programmed for action. Humans are evolutionarily programmed to react. When you see a threat, run away. When you see an opportunity, seize it. Don't wait in uncertainty, take action. This system works in reverse in the financial market. When the price falls, run. When the price rises, seize. When there is volatility, do something. However, in long-term investment, the correct move is often doing nothing. But our brain perceives this as a threat. 2. The illusion of control. Ellen Langer was one of the first to systematically study the concept known in psychology as the illusion of control. People want to believe they are in control even when they cannot control the situation. In investing, this works like this. Constantly checking the portfolio. I'm in control. Making a trade. I'm managing the process. Changing positions. I'm active, I'm aware. In reality, most short-term price movements are beyond control. But doing nothing feels like giving up control, psychologically. And this creates discomfort. 3. Fear of missing out. What if it goes up? What if I don't enter now? This feeling is called FOMO, fear of missing out, in modern literature. Daniel Kahneman is one of the names who systematically studied these tendencies in the field of behavioral finance. The human mind feels missed gains more intensely than gains achieved through patience. Therefore, investors become restless while waiting, because waiting equals missing a potential opportunity. 4. Loss aversion. An important finding from the same studies. People feel loss approximately twice as strongly as gain. Therefore, a small drop, big panic. A small rise, early selling. Doing nothing requires sitting with these feelings. This is mentally exhausting. 5. Action bias. There is a tendency observed in sports psychology as well. People prefer to make the wrong move rather than remain inactive in uncertainty. This is even stronger in the financial world because trading produces dopamine. Pressing the button gives a feeling of reward. The feeling of, I did something, is comforting. However, there are academic studies showing that the average performance of investors who trade frequently decreases in the long run. Brad Barber is one of the leading researchers who studies individual investor behavior in this regard. The general conclusion of the research is, as the frequency of trading increases, net return tends to decrease. 6. Patience requires cognitive resilience. Doing nothing is not suppressing emotions, is not being fearless, is not ignoring the market. Doing nothing is consciously being patient. This requires mental resilience. The strongest characteristic of long-term investors is often not knowledge, but emotional stability. 7. The I did nothing but I won paradox. The most interesting aspect of long-term investing is this. The best decision is often not to do more analysis, not to trade more, not to control more, but to intervene less. But this goes against human nature. 8. Why not trading is the hardest job? Because the ego is not satisfied. The brain craves action. Uncertainty is unsettling. Social media constantly presents opportunities. Short-term fluctuations generate fear. Not trading is a struggle not against the outside world, but against one's own mind. 9. What is the solution? Determine a clear strategy. If you don't decide beforehand, emotions will decide. Reduce the frequency of checks. Instead of checking 10 times a day, check once a week. Use automation. Create a regular purchase plan. Develop a long-term perspective. Look at the annual chart, not the daily one. Conclusion. The hardest trade in investing. Not trading. Because the human mind relaxes with movement. But wealth often grows with patience. The common characteristic of long-term winners is not making moves on every dip, but avoiding unnecessary moves. And this is perhaps more a matter of psychological maturity than financial acumen.